sorry, excuse me. We continue with our lecture. Let me do the recording first. It's not different actually. It's same. It just, I mean, the concept you need to really understand and apply it. That's why, if you have problem on that, so let us know. Any one of us will help you. That's why I said if you have problem, then we can, probably have a extra class just to clarify what you don't understand. So I was waiting for you to, to ask. Okay, so we continue with, so what we have covered last week is the financial statement of sole trader. Sole trader meaning peniaga tunggal. Okay, one person own the company owned by one person, and all the profit belong to him. So now we move on to the next one, that is introduction to limited company. Okay, remember the format of financial statement for this limited company is more or less the same like sole trader, but only a certain part there will be different. Okay, so I need you to remember the format. Okay, remember the format of a statement of profit or loss. So I always use the shorter one, which is sales less cost of goods sold, equivalent to gross profit plus other income less other expenses than net profit. So from there, I break it down so that I can get the complete format, the correct format. That is, if I'm talking about cost of goods sold, yeah, I can break it up to opening inventory plus purchases less closing inventory, isn't it? And then purchases, okay, if you have other expenses that is related with purchases, so you have to take into account. Like what are those? We have return outward, okay, we have carriage inward, wages, insurance on purchases, okay, custom duty for purchases if we buy from overseas. So this one, you need to use the first column, yeah, because we have three columns, isn't it? So the first column, just to do all the adjustments, right? So that is under SPL. Then, and in SOFP, so this, you just imagine the accounting equation, asset equal to equity plus liability. So we have, I mean, we do the presentation more or less the same like accounting equation, but it's just that the asset, we break it down into two. One is non-current asset. We have to present non-current asset first, and then followed by current asset. Okay, when we talk about asset, these are the item that is owned by the business to be used in the business. Okay, so how do we differentiate? Okay, non-current asset meaning can be used more than 1 year. And then current asset, the balance is changing from time to time. Okay, we have inventory, bank, cash, and then followed by equity. Equity, you have to show all the breakdown, like we have net profit, drawings. So we have to show that. So net profit with plus, isn't it? And then minus with the drawing. Then you have closing capital. Then non-current liability and current liability. That's all. That's how we present the financial statement for sole trader. So what are we going to do in a limited company? More or less the same, but it's just that we need to. There are few things that we have in limited company, but we don't have in a sole trader. And before we go further, so we need to know what are the features that we have in company. Okay, so these are the things that we need to cover. The new Companies Act, okay, and we have Companies Act 2016, limited company, and the characteristic, the different, okay, the difference between limited company and sole proprietorship and partnership, types of limited company, and then how the process of forming a company. Okay, you need to know all this because probably when you go out, at least you need the, I mean, you know the basic how to form a company, because when you own your own company, so you need to go through this process. And what is advantages, disadvantages of a limited company? Okay, a company may not purchase its own share, company capital structure and payment of dividend, removal of par value. Last time we used par value, but now we remove it. And then we have members resolution, and we have reserve of a company. So we don't have this reserve in the sole proprietor, only in company, and debenture as well. Debenture is liability. Yeah? And then winding up of a company, meaning if the company is failing, incurring losses for few consecutive years, so we have to wind up. Wind up means we close off the company. Yeah? And then, so either we wind up or we can do corporate restructuring. Okay, so now the new Companies Act, this is for your knowledge. Okay, with effect from 31st of January 2017, there was a new Companies Act taking its place. So we call it Companies Act 2016. So the old Company Act was Companies Act 1965. You know how many years gap? Yeah? So now we have a new one. So the purpose of introducing this new act was to modernize and make it the landscape for forming new companies easy. So many of the sections in this law have been simplified to make it easier to comply and more understandable. Okay, so that is telling us why we have shifted from the old Companies Act 1965 and now we have Companies Act 2016 because of few reasons. So the first reason is to modernize. Okay, modernize meaning we making the wording, because you know law, the wording is sometimes very hard to understand, the terms used in the law. So they make it simplified so people or public would understand it, and then it will be easier for the public to comply. Yeah. So, and they want to make it when form a company, so it's much more easier compared with the previous year. So they have to set the section in the new Companies Act. Yeah. So make it simple. So Malaysia and its company. So this is the statistic in 2017. So we have 1,251,190 company registered in Malaysia. Okay, and 6,859,080 businesses, sole proprietorship plus partnership. So it's far different. Okay, the numbering registered in this country. So this coming from all this data coming from Suruhanjaya Syarikat Malaysia, 2018. Okay, they made this statistic in 2018. Now it's 2021. So the figure is already different. At this point, the Malaysia ranked at number 12 among the world economy for ease of doing business. So last time, it was a lot of company from overseas, they would like to come to Malaysia, okay, because it's easy to do business in Malaysia. Excuse me. But nowadays, because of the instability on our political landscape, so a lot of investors are running away. Okay. Now, what is company? So company is a separate legal entity. When we say separate, separate means different from the owner in terms of legal entity, meaning in the law, so the company is regarded as one entity and the shareholders regarded another entity. So they are different. Okay, separate legal entities. So having a separate and distinct existence apart from the natural person who created it. Okay, so when company sue another company, okay, they are suing the company, not the shareholders. Huh? So because they having separate legal entity. So most company are formed as limited liability. What is the meaning limited liability? So the liability of the shareholders up to the share that they have in the company. Okay, if the shareholders already paid all the share in the company, so that's it. That is the only liability the company, I mean the shareholders has. So in case the company fail, okay, and then the company cannot settle the liability, so the payable who cannot go after the personal belonging of the shareholders. That is the meaning, limited liability. But opposite from sole trader is unlimited liability. Meaning, if the business failed to make payment all the payables can go after the personal belonging of the sole proprietor or the sole trader. Okay, that is the meaning of limited liability. The liability of its member is limited to the amount they have agreed to pay on the share. So if they have paid all the share, then there's no more liability. Yes. Now, these are the characteristics of a company. This distinguish company from other form of business organization. So different from partnership, different from sole proprietor. So what is the first characteristic? Because of legal personality, legal entity, meaning the company has legal personality, which is the company is regarded as an entity that they can own a property, they can buy a property, they can sue the customer. So that is the meaning legal personality is considered as a person. Okay, a company is regarded having a separate legal entity. It is an artificial person that can own property, can make contract, can sue, and can be sued. The company separate entity distinct from those who own it. That is the first one. So, like sole trader, they are regarded as one. The owner and the business. Okay, if the business cannot pay, so they can go after the owner. Okay, perpetual succession. Perpetual means continuous. Succession meaning uh, the successor that is taking over the company. They can, this is continuous. Yeah. As a company is a separate entity, its ownership can change. So the ownership, we are talking about the successor, the owner, the change of the ownership can change without changing the company itself. It is unaffected by changes of ownership when shares are transferred or when shareholders die. It is assumed the company will continue perpetually until it is wound up. So meaning if there is a changes in ownership of the shareholding of the company, it doesn't affect the company. Meaning the company is still continuing, unlike partnership. Like if one of the shareholders or one of the partners die, so the partnership business automatically dissolve. They cannot, proceed to do business transaction. But company is different, the opposite. That's why we call it perpetual succession. So continuous. Okay, meaning even though one of the shareholders die, okay, they can still continue the operation. Or even though the majority of the shareholders sell this entity, the operation is still continuing. Okay, it doesn't affect, yeah. So that is what we call perpetual succession until it's wound up. And then the third characteristic is separation of ownership from management. Shareholders, not majority shareholders. So separation of ownership from management, meaning the owner, that is the main shareholders. The because we call the owner as shareholders. Shareholders is the one that will buy the share of the company. So the majority shareholders, even though they're holding of maybe out of 100% of the shareholding of the company, they cannot participate in the management. Okay, because this is the characteristic separation, meaning the owner cannot participate from the management. The company will be managed by professional managers, which they selected. Okay, they will have directors, managing directors. So all these person, managers, directors, managers, managing director, all these are selected by the shareholders. They can select, but they cannot participate. So that is the rule. That is the characteristic. Okay, shareholders may or may not take part in the management of the company. Usually, if the company is small, like a private limited company, and the shareholders are also the directors and managers. So we it depends on types of company. We have two types. One is private, and the other one is public limited company. So private. How do we distinguish between private and public limited company? You look at the end of the name of the company. So if it's ended with Sandan Berhad, so that is indicating private limited company. If it's ended with Berhad, then this is public limited company. Okay, for a bigger company like public limited company, shareholders usually appoint directors and managers to manage the company. They cannot participate the managing, the management. Okay, because of the characteristic separation, ownership from management. But private limited company, the shareholders can be the directors, can be the managers. So that is the difference between these two. So any example on public limited company that we have in Malaysia? The biggest one is we have Petronas. Yeah, Petronas Berhad. Or even we have PMB Berhad. So those are a limited, I mean, public limited company. Now, so this is comparison between sole proprietorship, partnership, and limited company. So these are all the factors that differentiate them. Okay. So normally you'll be given, I mean, from time to time they ask you what is the difference between these three entities. So the first thing, okay, we look at capital contribution. Capital contribution referring to uh, the injection of the capital by, if it's sole trader, by the owner. If it's a company, then by the shareholders. So in sole proprietorship, we call it capital, isn't it? So that is own contribution, 1% only. Okay, own contribution. But for company, we call it share capital. We don't call it capital only, share capital, because they are given to the shareholders in terms of share. Okay, we call it share capital. But for partnership, we call it partnership capital contribution. Okay, and partnership we have general partnership and we have limited liability partnership. So general partnership meaning the liability of the partners is unlimited, but limited liability partnership, the liability of the partners is limited to their share. Okay, so they call it partners contribution also lah. So different term they use. If it's in sole proprietor, the own contribution we call it capital. So general partnership, partnership capital contribution. For limited company, we call it share capital. Okay, that is for capital contribution. Who are the owner of the business? Okay, for sole proprietorship is the sole trader, isn't it? So he is the owner. For general partnership and limited liability partners, okay, all this owned by partners. Okay, For limited liability partners, LLP itself. So partners have a share in the capital and profit of the partnership. Okay, that is in terms of owner. But what about limited company? So the company, limited company owned by the company itself. So the member or the shareholders own share in the company. Okay, they can vote. All right. So who own the company is the limited company itself. Legal status. So when we talk about legal status, okay, we are considering the status of the entity in terms of legal, yeah, legal view. Okay. So for company, the company is considered as a separate legal entity from the shareholders. So same goes with limited liability partnership, separate legal entity. But for partnership and sole proprietorship is not a separate legal entity. They are considered as one. Yeah. So if the business fail, so the people can go after the partners, can go after the sole proprietor. Okay, that is about legal status. Now, party that is liable for debts of the business. Okay, debts, meaning we are talking about if the business fell, okay, not enough asset to pay for all the payables. So the debts is who is liable or who is responsible for the debts. For company, because of legal entity, the company is responsible, okay, for the debts. And for limited liability partnership, the limited liability partnership is responsible. For partners and sole proprietorship, okay, the individual partners, the owner, the sole trader, okay, meaning the liability is unlimited. Unlike these two, limited liability partnership and the company, they limited to the share they're holding. Okay, so responsibility for management of the business. Management of the business meaning who is running the business. For company, board of directors. Who runs the business? The board of directors. For limited liability partnership, okay, the limited liability partnership is responsible. Yeah, responsible managing and the partners. Okay, and then what about the partnership? The partners as well. And then the sole proprietorship, the sole proprietor. Okay, so these partners, sole proprietor is the owner, isn't it? But board of directors is not the owner. Different. Board of directors is the professional managers that is selected by the shareholders. Personal liability. So for company, no personal liability. Okay, no personal liability of individual director or shareholders. Liability borne by the directors or shareholders are to the extent of unpaid share only. That's what I'm saying. If they have paid the share, so they are no longer responsible of any of the debts. Unless, okay, they haven't paid fully the share, then the owner or the shareholders or the directors, okay, they have to pay for the unpaid share. For limited liability company, partnership, okay, no personal liability of partners, okay, except for own wrongfully act or omission or without authority. So meaning they are not responsible for the partnership debts. But then, except, except. So meaning in case they have wrongfully acting for the partnership and make a loss, yeah, towards the partnership, they are responsible, right? Liability borne by the partners are jointly and severally with the LLP to the extent of contribution only. Meaning, what does it mean? Meaning their debts towards the liability limited to their shareholding in the partnership. So normally in LLP, limited liability partnership, they have one partners unlimited. So meaning in case the partnership fail, okay, so this one partner will be responsible for all the debts. Okay, normally this unlimited liability partner will be the person who manage the business, the partnership. Okay, and then partnership, okay, the normal partnership, they have unlimited liability, just like the sole proprietor, unlimited liability. They are jointly and severally liable with the partnership, which can extend to personal asset of the partners. So same goes with sole trader, can extend to personal asset of the sole trader. Okay, so that is a difference. Now, number of shareholders or number of partners. So for a company, minimum one. Okay, only for private company we have maximum. That is 50. If it's a public limited company, no limit. Okay, no limit. Only private company we have the maximum amount. For LLP, limited liability partnership, minimum two and no maximum limit. LLP. But for the normal partnership, maximum is 20, minimum is two, except for partnership for professional. So meaning this one is like they have professional partnership like accountants partnership, lawyers partnership. They don't have the what do you call that maximum. Okay, for sole proprietor, only one person. Except for partnership for professional practice with no maximum limit. Okay, any question on this one? Can you understand the difference between the business ownership? Kevin?
Is it we learned before earlier on the
Huh?
earlier chapters? Earlier chapter we talk about this sole proprietors just briefly only, and then now we more in depth about them.
Yeah. Mm. So this one is like comparing with other business ownership. Okay, so maximum number of members in a private company is 50. So this is enacted in the section 42 of Companies Act 2016. Can the director and shareholders be the same person? Yes. Okay, director. Okay, this is one of the management. The one member can be both director and shareholders. One only. One member can be both director and shareholders. So minimum number of members in a company and partnership. The minimum in a company is one or more members. But for partnership is two. Okay. Now types of limited company, like what I've said to you, we have two types: private company, Senam Berhad, and then public company, ended with the word Berhad. So company are normally formed as having limited liability. So what is limited liability means? The liability of the member are stated in the company's constitution, and it is limited to the amount unpaid on the share held by them respectively. So this is repeating unpaid, okay? Meaning it's very important for you to understand. So they are only responsible for those unpaid on the share held by them. If they have made all the payment on the share they own in the company, so then there'll be no more liability. Now, when the share are fully paid up, there is in general no further liability, just like what I've explained. Should the company be unable to settle all of its debt upon liquidation, liquidation means the company has been wind up, meaning the company has so many liability exceeding than the asset, so the company have to be closed down. So that is liquidation. The debts upon liquidation, so unable to settle. So the companies payable have no right to seize upon the personal asset of the member, meaning they cannot go after the personal belonging of the shareholders. So that is the meaning limited liability. In other words, the personal asset of a shareholder, such as his house, car, etc., cannot be taken by the company payable to settle the company's outstanding debts. So we have two, okay, private. So how do we know it's private? So you always look at this, the ending of the name of the company, Sendam Berhad. If it's Berhad, then it's public company. Okay, companies can be unlimited in liability also, can, but then this is very rare. Meaning, I've not seen any yet, but it's possible to have unlimited liability for company. Now, this is the process of forming a company. Okay, to form a company, the minimum number of a company members of a company, okay, should have is now one. One person can set up a company. Instead of going for sole trader, they can go for company. Why? Because if you go for sole trader, meaning your capital only restricted to one, so you cannot expand your business. So if company, you can expand the business because it depends. If it's private, then only 50. But then you want to go public, then you can have no limit. Okay. The constitution of company may consist of, okay, we have a constitution and we have may consist of the object of the company, the capacity right, the capacity, the rights, the power, and the privileges of the company if the provision restrict such capacity, rights, power, or privileges. So if there is a restriction, then in the constitution there will state the capacity, the rights, the power, or privileges. But if there is no restriction, then you don't have this. Any other matters as the company wishes to include in its constitution. So meaning the first thing before we can form a company, so you must have the constitution first. So in the constitution, what you must have is the objective of the company, the object of the company, yeah? And then any important matters that you should include. So the company may alter its constitution by special resolution. Okay, meaning once you have set up your constitution, so the terms in the constitution can be edited, can be changed, can be modified, but then you need to go through special resolution. And what is special resolution? Meaning this is a vote. Okay, the shareholders will do the voting, and the voting must at least 75% vote. Okay, favorable, meaning they support with the changes. If lesser than 75%, you are not allowed to change the constitution. Okay, that is the meaning special resolution. So there are two constitution, yeah, that we need to have in forming a company. One is memorandum and article of association, they call it, and then oh sorry, memorandum and article of association. There are two. So it is acceptable for company to write up these two documents as their constitution. The different Companies Act 2016 is that the entire Company Act seems to serve as a constitution for company. Okay, what we have in the Companies Act 2016, that is actually the complete constitution. There will be served as constitution for company. So there is less need for company to write up memorandum and article document. Okay, last time previously using Companies Act 1965, you have to prepare memorandum and article of association, where there are certain issue that you need to write in a memorandum and certain issue in article of association. But now they make it simple. Okay, so they don't have to write the memorandum and article document. Okay, what is written in the Companies Act 2016 is regarded as the constitution of the company. Okay, so that is the process of modernization of the Companies Act. Yeah. So if the company does not have constitution, then the right, power, duties, and obligation as set out in Companies Act 2016 will be the constitution. Okay, they can opt to not to write any memorandum or article of a documents now. Okay, so if that is the case, meaning this Act 2016 will be the constitution. Now, previously we have, in Companies Act 1965, they have set this authorized capital. Okay, authorized capital meaning these are the amount of capital that the company can issue. Yeah, the maximum they can issue, but the authorized capital can be amended. Okay, through application to the uh, registrar of company. But now, since the existence of Companies Act 2016, this authorized capital was abolished. Yeah, abolished requirement to state it. Previously, it was required to state the amount of share capital, if any, with which the company proposes to be registered and the division thereof into share of a fixed amount. That is Section 18 of Companies Act 1965. So meaning these are the requirement by these old acts. Yeah, that is you have to state whenever you want to prepare your statement of financial position. So the first item that you need to state, yeah, is your authorized share capital. Okay, but that is not part of the amount of statement of financial position, but it is an info basis only. Okay, so this was referring to authorized share capital. But now in Section 35, Content of Constitution, Company Act 2016, there simply isn't this requirement to state how many proposed share authorized share capital anymore. So meaning it's no longer needed to be stated in the statement of financial position any longer. Okay, because of the requirement under Section 35 Companies Act 2016. Okay.
Then who police them on the constitution or their own company?
Come again. Who is checking all this?
Who checking their own if they follow the constitution, their own constitution,
Normally the accountants, lah.
their own accountants.
Yes, the accountants of the company. Yeah, they have to do to ensure they are following all these, rules and regulations set by the Companies Act. Because once you publish it, and then it is not according to the rules and regulation as or standard stated by this act, okay, you're gonna be penalized. So meaning that will be a failure of as an accountant of the public company, isn't it? So you
Not
don't normally the accountant wouldn't do that. They don't want to jeopardize their reputation, so they have to ensure all these are being observed
the
observed by.
public can still check all the things for
Well, actually, those public company they are required to publish the financial statement. So meaning anyone can access.
even the constitution.
Yes.
Uh,
Mm. Because now we don't have to do. Last time we have to do the memorandum and article of association, but now the company are not required to do that already. So meaning what you have in the Constitution on Companies Act 2016, that is the Constitution. That is what the company is practicing. So everyone can access that information. Okay,
Okay.
good question. Now, next thing is advantages and disadvantages of operating as a limited company. Okay, we need to know all this because uh, then you can decide whether you want to open, let's say you want to open a business, so you want to open as a company or not. Okay, the advantages as a limited company, okay, you have limited liability. Okay, limited liability as a separate legal entity, a company is responsible for its action and liability. Payable have claim only against the asset of the business, not against the personal asset of the shareholders. So that is the limited liability means. They can only uh, go against the asset of the company, but not the shareholders, because the owners of the company are not personally liable for corporate debts. The maximum amount they can lose is the amount they have invested in the share. So to investor, this is one of the most important advantages of the corporate form, since under the alternative form of business organization, owner may be personally liable for business debts. Okay, that is these are the main features that normally investor means pelabur, they want to invest in a company rather than in a sole trader because they don't want to personally liable for the debts of the company in case the company gone bankrupt. So they only want limited liability, just like this. Yeah. Okay. And company has a broad source of capital, meaning they have so many resources of capital, broad source. Yeah. Ownership rights in company are represented by transferable share. Okay. Ownership of the company you can transfer by share. Yeah. By dividing ownership of the business into many shares with relatively small value per share. Normally, they will sell in the market, okay, depending on the value. So sometimes one share costs only like 2 ringgit or 2 ringgit 50. So it depends on the market value. But if the value, I mean, if the company, making a lot of positive news, the share price will rise up. So sometimes come to 10 ringgit per share. So meaning one share is small value per share. So enable large investor and small investor, even small investor, they are able to participate in the ownership of the business. So therefore, that is what we means the broad source of capital, meaning at any time, if need arises, the company can sell off their share to the public, and a lot of people, okay, investor eligible, those corporate investor or individual investor can buy the share. So meaning you have broad resources, yeah, at any time. So most large public company can therefore draw upon the saving of many people to obtain the capital they need. So if they need capital, you can always issue a new share. And then if the reputation of the company is good, so sometime the public, the company only need 100,000 number of share. But instead, people go and apply until 500,000. So meaning a lot of investor are, scouting for the share of that particular company. So everyone is trying to participate. So we have oversubscription of the application. Okay. For example, a company's capital 1 million may be divided into 1 million share and 1 ringgit each. does allow many small investors to buy small parcel of share. So that is the meaning broad source of capital. Okay. So if you ask one individual to contribute or buy the share 1 million ringgit worth 1 million ringgit, so it's quite impossible, isn't it? Because I mean, it's very hard to find one individual can provide that 1 million. Company maybe, but then company also will think twice. They cannot, just invest 1 million into one business, isn't it? So, in order to distribute, in order to get this 1 million, so the company have an option. They break this 1 million into 1 million share, and each of the share is only cost you 1 ringgit. So even a small investor that only have 500 ringgit, they would willing to invest, isn't it? They buy 500 share only. So if you have one individual having one investor having that 500, so if you have uh, how many? Probably 10,000 investors having that the same. So you can reach up to 1 million. So that is the meaning, broad source of capital. Okay. Then the next one is continuity of existence. Continuity of existence, meaning the existence of the business is continuous. It doesn't stop until it really cannot settle the debts, so bankrupt, then they close. That is continuity of existence. A company has indefinite life. Indefinite life meaning something that is infinite. Yeah, you can't define until when. Yeah, indefinite life and continue in existence even if its ownership change, meaning when one of the shareholders, okay, owning 20% of the share, the total share, 20%, sell off, okay, it doesn't affect the continuation of the business operation. Okay, that's what we call attribute of perpetual succession. Perpetual is continuous. Huh? The transfer of share from one owner to another has no effect on the continuity of the company. In contrast, the death, incapacity, retirement of an owner terminate the business of sole proprietorship or partnership. So meaning in comparison, this company with the other business ownership that is sole proprietor and partnership, okay, once you have this, yeah, debt, incapacity or retirement, so that business stop, that business will dissolve, but not for company, continuity of existence. So one of the advantage. And then ready transferability of share, meaning we are talking about the share that owned by the shareholders. It can be transferred from at any time, meaning if the shareholders need cash, but their cash is tied up with their investment in the share in the company, so they can sell it off because they have the features ready transferability, meaning especially those share is listed in the Kuala Lumpur market, yeah, Bursa Saham Kuala Lumpur. Yeah, you can sell off at any time. So company share may be transferred easily without disrupting the activities of the company. Share in public company can be bought and sold through the stock exchange. Consequently, a shareholders can readily convert his or her investment into cash when the need arises. Meaning, you can always, decide to do the investment, but let's say you have an emergency case, okay, someone, your relative died, and then you need cash. So you can sell off this your shareholding immediately. And sometimes in the same day you can get your cash back. Okay. And then use of professional management, meaning like what we have learned just now, the shareholder cannot participate managing the business. Okay. So although the shareholders own the company, they do not manage the daily affairs of the company. Shareholders elect a board of directors, so which has overall responsibility for the business decision. So the board then hires a president or managing director and other professional managers to manage the business. In contrast to a partnership, no mutual agency exists in a company. An individual shareholders does not have the right to bind the company to a contract unless he or she had been hired as a director or employee of the company. So this separation of management and ownership permit the company to hire the best managerial talent available. So meaning to say, because they cannot participate into managing the business, okay, the shareholders can elect, yeah, who is the directors and who is the managing director. So when they elect, they select the professional, those with experience. Okay, meaning they have to check the background, isn't it? So if they are professional and they have proof, track record, evidence, so meaning the company they are investing in is in a good hand, yeah, managed by professional managers. So meaning if it's managed by professional managers, so definitely the company, okay, the possibility of the company making money is very likely to happen, isn't it? Okay. So that is the meaning. That is the advantages. Use of professional management. Now, any question on the advantages?
No.
Okay. Now, next one is disadvantages. Even though there's a lot of advantages in companies, but you also have disadvantages. Okay. So the disadvantages is because the company business ownership, okay, they are holding, especially the public limited company, they are holding the public fund. Public fund meaning can be anyone, can be from anyone, from the public. So, and managed by professional managers, which is not the shareholders, isn't it? So, meaning they are managed by someone that is not one of the shareholders. So therefore, the government, okay, in order to make sure the public fund is being managed correctly, okay, they have put all this governmental regulation. So the purpose of this regulation is to ensure, okay, all the information that is restricting them to do the personal interest, okay, is being avoided. Okay, that is why this is disadvantage to company also because they have a lot of greater governmental regulation. Companies come into existence under Companies Act 1965. Consequently, they are subject to a greater degree of control and degree of supervision by the government than are the sole proprietorship or partnership. So meaning if they have a greater degree of control and supervision, meaning more cost for the company to, to incur because they have to follow the government regulation. In addition, public company must prepare annual financial report for presentation to their members and to the stock exchange on which the share are traded. Now, when you prepare the annual financial report, so you need to prepare this. Last time in hard copy, everything is colored, hard copy, and then all these are costly, very costly. And the paper are glossary paper, so presentable. Yeah, and these they have to make copy and then give it to all the shareholders, and then to the government. This annual report must be prepared in accordance with approved accounting standard. So approved accounting standard, they have to follow the rules and regulation or the standard that is set by international or even Malaysian approved accounting standard. So in order to ensure they are, following the approved accounting standard, meaning they have to hire a professional accountant which know all this accounting standard, isn't it? So that is why it's very costly. And with the listing requirement of the stock exchange, hence meeting this requirement often can be very costly and time consuming. Time consuming meaning you don't prepare it like today, one day, then we can prepare. This one is, taking longer time because you have to make sure all the rules and requirement are being, observed. Okay, so time consuming. So that is the first disadvantage. Second one, separation of ownership from management. Just now it was an advantage, but separation of ownership from management is disadvantage also. Okay, the use of professional managers was cited earlier as an advantage. In some cases, however, this separation of ownership from management may prove to be a disadvantage because managers may sometimes operate companies for their own benefit. Own benefit, meaning because they are in the position to decide, to make decision. So let's say if the decision, they have a personal interest on it, so they will favor to their personal interests rather than the profit maximization of the shareholders. So that is, this is human weaknesses. Okay, so they operate company for their own benefit rather than for the benefit of the shareholders. So considerably harm may be done before shareholders become aware of the condition and take action to change the management. Sometimes, because a lot of cases, company being managed, uh, I mean, the managing director manage it. Okay, he prefer uh, to make decision based on his personal interest rather than uh, the interest of the shareholders. So these shareholders did not detect it until 3 years later. But by that time, the company already in a bad shape. The company have to, they have a lot of debts, they have to incur losses, they have to bear all the costs. So this is disadvantage when it is separation of ownership from management, meaning they they can't participate, so they don't know, they don't have the information which the managers have. Okay, so the managers have the information, and sometimes when they decide, they can decide, and they decide according to the personal interest. Okay, so many legal requirements in the Companies Act have been established to discourage management from acting in their own interests to detriment of shareholders. Okay, so meaning that is why there is a lot of governmental regulation that is imposed on company, because the government is trying to protect, the shareholders, trying to protect the public fund. Okay, so those are disadvantage. Now, a company and the purchase of its own share. Section 123, a company is normally not allowed to give any financial assistance for the purchase of its own share. So meaning in this act, 123A, so they are not allowed, okay, prohibited buying their own share. So some exception to this rule where the lending of the money is part of the company ordinary business, unless, yeah, this meaning the section is not applicable if this is happening. There are 5 situations. So which is one of the exception is one of the ordinary business activity of the company is giving loan, yeah, lending of money. And then where it is for a trust scheme for employees. Okay, meaning that is to setting up a trust for the benefit of the employee. And where the financial assistance is given to employee for their own benefit. Okay, meaning they give financial assistance because this is for the benefit of employees uh, in overall. Just now is a trust, but this one is for the benefit of the company. And the fourth situation is where the company is regulated by written law relating to a bank, insurance, or takaful, or which are subject to supervision of Securities Commission. Okay, meaning the company is related with investment. So that is why they are under this Security Commission, regulated by written law relating to bank, insurance, or takaful. And the last one, where the company is not a public listed company and it has comply with further condition listed in section 1 to 6. So this is your own knowledge only. Yeah. Any questions so far? Can you understand this one?
Right.
No, huh? Okay. A company buying its own share. Generally, a company is not permitted to purchase its own share or that of its holding company. Okay, with the following exception: a redemption of preference share, cancellation of share, a share buyback by a public listed company, a remedy awarded by court in the case of oppression. Okay, so meaning buying its own share, we are referring with buying the ordinary share. Sorry, the share capital. Share capital, there are two. One is ordinary share, and the other one is preference share. So preference share, if it's a redemption of preference share, redemption meaning the company buys back the preference share. Okay, so if it's redemption of preference share, is allowable because uh, preference share carrying fixed dividend. Every year, the company is obligated to make a dividend to preference share. So in order to avoid a fixed dividend, the company buys back the preference share. So this is allowed. Okay. Cancellation. Cancellation of shares, meaning we are canceling the share. We don't want the share to be too many shareholders, and the company decided to cancel the share. So this is permitted. A share buyback by public listed company or a remedy awarded. I mean, if it's public listed company, they can buy back the share, lah, right? And then the other one is if this this issue has been brought up into the court, and the court has decided, okay, a remedy, meaning a resolution. So awarded by the court that because of oppression, so meaning the majority shareholders is taking advantage on all the decision of selection, yeah, of the or either voting right. So this is considered as oppression by the court. So the court award the company, okay, to buy back that share in order to reduce the majority. Then that can happen. Okay, that is permitted with the following exception. Okay.
The redemption is what again? Can you explain?
Redemption means the company buys back the share from the existing preference shareholders.
Is it they sell already and then they get it back?
Yeah, they already sell to the preference shareholder, and then at the certain time, okay, after probably they are now recouping, profiting, and then they want to avoid by paying fixed dividend on preference share, so they buy the share, yeah, from these preference shareholders. They
Or
buy back.
usually not same price, right?
It depends on the agreement between the company and the shareholders.
Oh, okay.
So if the preference share agree, and then with extra, then the company also agree, then that will be the price.
Or the redemption they already set up early already.
Mm, yes. Sometimes when you have this preference share, at initial stage, when you sell, the company sell to the preference shareholder, okay, they already have the agreement. When is the redemption date? Let's say the first year one, and then year one they make the agreement, so they only do redeeming, okay, in year five, for instance, and in what price? So 10% extra. So meaning uh, in year five, then the company can redeem that preference share.
So
Okay,
means if they buy the shares, they don't have to distribute the dividends, right?
come again. Oh, you mean the company, after they redeem, they don't issue it to the public anymore? Is that
Oh,
what you mean? No.
I mean the dividend.
Or the dividend. Well, when they already redeem the preference share, so the next year there will be no more dividends from the given to the preference share. It will be reduced.
Oh, okay.
Okay. Now, company may reduce its share capital. Section 115 provide that the company may reduce its share capital following the procedure prescribed in the section unless its constitution provide otherwise. So meaning if you have a company and then you want to reduce the share capital, so this is a procedure that you need to follow. And then you have the section 115. According to section 115, the company may reduce its capital by either, okay, these two. One, using special resolution supported by solvency statement from all directors. Two, special resolution confirmed by the court. Okay, meaning you can reduce the share capital when all of the directors supported the resolution, a special resolution, or either because of the court order. Yeah. Note, as a general principle, a company does not reduce its issued share capital. However, the above is an exception. Okay, in general, the company cannot reduce the share capital unless under section 115 you have this, then it will be reduced. Okay, company capital structure and payment of dividend. Now, so this is the common capital structure of a limited company or public limited company. So in general, there are two classes. So we have preference share and we have ordinary share. So what is the difference between these two? Okay, preference share is a share does not entitle the holder to the right to vote, meaning they cannot vote. So let's say the company need to make a resolution. Okay, one of the example is they want to select the managing director. Okay, they need to do voting. So Only ordinary share can vote. Preference share cannot vote. Okay, or to any right to participate beyond a specified amount in any distribution, whether by way of dividend. Okay, preference share, the word itself, preference, meaning they are preferred. So the preferred is given a fixed dividend. Fixed dividend like 7%, 6%, 5%. So what does it mean? Normally, the name of preference share will be followed by, before we, before the name of the share, we state the percentage of dividend. Let's say 7% of preference share. So that is the name of the preference share, 7%. So what does it mean, 7%? 7% means every year the preference share are receiving 7% as a dividend. So based on what is the investment, 7% times with the investment. So whether the company are profiting or not profiting, this dividend has to be paid. Okay, that is preference share. But any excess, yeah, that is, let's say the company is profiting and they have a lot of profit. Even after paying the preference share, they have extra. They are not, they don't have the right to participate beyond the specified amount. So, and this, it can be called by other name other than preference share as long as it fulfill characteristic of preference share. So it's different from ordinary share. So ordinary share can vote. These shareholders can vote at the general meeting. And this also no upper limit to the amount of dividend they can receive. Meaning, if the company is profiting, so after paying all the preference share dividend and they have extra, so the ordinary share can participate the extra as a dividend. Meaning there's no upper limit. There's, let's say, after the dividend, they can, I mean, if the management decide to distribute all the remaining profit as a dividend, they can go up to 20% or 30%, 40% dividend. But that is depending on the management of the company. Okay, that is the meaning. No upper limit. But the problem is they are not receiving fixed dividend. So in case the business are not profiting, if the company are not profiting, incurring losses for 3 consecutive years. So out of the 3 years, they cannot, they don't, I mean, the company are not obligated to pay the dividend, any dividend to the ordinary shareholders. So that is the disadvantage. But then if the company is profiting, so they don't have upper limit maximum. Yeah, we're talking about maximum limit. So of course, when there are no profit left after paying the preference shareholders, they may receive no dividend for that year. So that is the risk.
Can the public buy the preference shares?
Come again? The public,
The public
mhm.
buy the preference shares.
Yeah, if they decided to, I mean, they have to make a choice whether they want to invest in the ordinary share or in the preference share. So by looking at the advantages and disadvantages. So for, let's say, if long term, the investor will decide to invest in ordinary share. But for short term, the investor would like to invest in preference share because they can get the dividend, fixed dividend every year.
Okay.
Yeah.
So
So that is depending
even
on
so,
the
both the shares won't get money if the company if there's no profit.
preference share. If the company is not making profit, they're still receiving dividend.
Or they still have a set dividend to get, even though
Yeah.
the farm company don't get profit. Just the
Yes.
ordinary won't get.
Yeah. Ordinary share, they no dividend if it's the company is not profiting.
Oh, okay.
But if the company is profiting, so ordinary share doesn't have the maximum amount. So it depends on the management. How much is the dividend to be declared to the ordinary share? So normally it will be much higher than preference share. Lah. Okay, something to note for directors or managers regarding dividend. So this one is be careful if you are selected probably as a director or manager for corporate, yeah, for companies. Okay, under section 133 subsection 2, provide for the liability of the director and manager who willfully paid or permitted to be paid dividend out of what they know to be not profit. They are liable to the company to the extent of the amount exceeding the value of any distribution of dividend that could properly have been made. So meaning, okay, because like what I've said, the management is who deciding the amount of dividend, isn't it? So that is referring to the directors and the managers are the management. Okay, when they uh, declare or willfully paid or permitted to pay dividend out of what they know to be not profit, meaning even the company are not profiting, but they are still declaring dividend to the ordinary share. Okay, so they are responsible responsible for that payment to the extent the amount exceeding the value of any distribution that could properly have been made, meaning they have to pay back. If this is caught, right? I mean, if you are caught declaring a dividend more than the profit of the company, okay, to the ordinary share, so he will be responsible for it and they have to pay. Yeah. Section 131 state the rule for dividend. The dividend should not be paid if the payment will cause the company to be insolvent. The directors are responsible for this. Okay, meaning if the company is not cannot afford to pay the dividend, they shouldn't declare the dividend because when they pursue to pay the dividend, it will cause the company to be bankrupt, insolvent. So if this thing happen, the directors are responsible for that payment, that dividend payment. Okay, next one is removal of par value. Last time we have par value. Par value is the value that is used by to determine the dividend amount. Yeah, meaning par value is the original value, the nominal value. Okay, that is other name for par value. Original value, nominal value. So with effect from 31st of January 2017, all companies with share capital migrated to no par value regime. Okay, the Company Acts 2016 reads, all share issued before or upon the commencement of this act shall have no par or nominal value. Okay, it's been removed. So we don't use this term anymore, par value, nominal value. Huh? So members' resolution. Normally, a members' resolution are decision made by members. Okay, what is resolution? Meaning, these are the referring to decision made by the members. Okay, voting, through voting. So normally, members' resolution are passed at general meeting. So general meeting, we have two. One is annual, that is known as AGM, annual general meeting, and the other one is extraordinary. However, when there are only a few members, calling for general meeting can be burdensome. So the Act provides for a written resolution, thereby only needing to be circulated to the members. So this is allowed for a private company. Okay, because sometimes not all the members comes, yeah, so not enough quorum. So what they have to do, they circulate in written form, and they do the voting using that circulated form. Okay, so this is allowed for private companies. So whatever decision made during that is known as members' resolution. Whereas for public company, a resolution of the members shall be passed only at the meeting of the members. So this does not apply to public company, only private company. Just now, that is in written form. So they have circulated, okay, to the members, circulated to the members, and this can be considered as members' resolution. But public company, it must be passed only at the meeting of the members. Okay, a Berhad does not have to be a listed company. So Berhad is referring to public company. So public company is not a must for them to be listed. Listed means it is listed under uh, Bursa Saham Kuala Lumpur, or we call it Kuala Lumpur Stock Exchange. So it can be listed or can be unlisted. So a public listed company refers to the one that is listed on the share exchange. So what is the advantage of being listed? Okay, making it easier for the public to buy the share. So meaning the source of capital is more broader than the one that is not listed. Okay, Section 301, written resolution. A written resolution may be proposed by the directors or by any member holding at least 5% of the voting right in a private company. So written resolution, meaning if it's private company, they are allowed to do this, but the condition is the director must be holding at least 5% of out of 100% of the voting right. Section 302 provide that a lower threshold may be stated in the company constitution. So meaning not only 5%, but the lower than this can be, but must be stated in the company constitution. Meaning one of the condition. All right. So if it's not stated in the constitution, then we follow the general, which is at least 5% of the voting right. Ordinary and special resolution. For an ordinary resolution, it is passed if it's agreed by a simple majority. So meaning these are like our guide when to have a resolution. We call it ordinary resolution when the agreed, okay, we only manage to get simple majority. Simple majority meaning more than 50%. But if we need a special resolution, then it requires 75% of the members. So that is the difference between ordinary resolution and special resolution. Ordinary, okay, simple majority only, more than 50% only. But special, you need 75% of the members supporting. Yeah, that is special resolution. Now, written resolution. The period for agreeing to a written resolution is capped at 28 days from the circulation date, unless the company has different time limit written in its constitution. So this is stated in the Companies Act. Yeah. Okay. Maximum. Okay. For written resolution that is circulated among members, which is only applicable to Berhad, private limited company. Sorry, not Berhad, Sindang Berhad, private limited company. Okay. Meaning the written resolution, okay, it can be circulated maximum 28 days. Yeah, 28 days. But uh, other company also, they can have more than 28 days or lesser than days, if they have stated in the Constitution. If not, then they have to follow this general cap 28 days stated in the Acts. Okay. So member who vote after this 28 days to the opposed written resolution cannot be counted. So any resolution that need to be in written, okay, for private limited company, okay, if you have voted over, after 28 days, so your vote will not be counted in. Only those vote that made before or on 28 days will be counted in. Okay, unless in the Constitution they have written 30 days or 31 days, then we will follow what is being written in the Constitution. But if none was written in the Constitution, so they have to use the general from the Act, Companies Act, 28 days.
So for
Okay.
the special resolution, if we
Mhm.
only got 55%, what happened?
55%, then is not settled because the special resolution need to be 75%. Let's say they want to decide to replace the managing director, and during the vote only 55%. So the decision to remove that managing director will not be continued. They will not execute the removal because they did not manage to get the special resolution, which is 75%.
Oh,
Mm.
okay.
Okay. Other than that, good question, Noel. Farah?
So
Ferrous electricity down.
Hah? Bila lagi?
I
How
don't
long
know,
already?
several minutes.
Huh?
Like 15 minutes.
50 minutes? Oh, okay. Now can you hear me? Because my phone no battery.
Okay.
We can
Okay.
hear. We can hear.
Okay, let me know if it's not clear. Now,
Okay.
we look at the format. Yeah, the format now. The format of capital and reserve in the account. So we are referring to the statement of financial position. Statement of financial position. Okay, under capital. In the sole trader is under capital. So now, for company, slightly different from the sole trader. So let's say this is the company that we have, Modern Sdn Bhd. So this is private limited company, Sdn Bhd. How do I know? I look at the name, Sdn Bhd, and statement of financial position as at 31st of December. So this is only extract. So normally, after we listed the asset, so followed by capital. But then for company, we must put the heading as capital and reserve. Okay. For sole trader, we only put capital, isn't it? But for company, we put capital and reserve. And then first thing, we list down the capital. Capital. So remember, just now in the note says we have two types of share capital. One is ordinary share, and the other one is preference share. Now, when we do this, the listing, so we need to list the number of share first. So this is the number of ordinary share, 5 million ordinary share, and then put the value as 5 million on the second column first, and then 2 million, 7% preference share again. So this one, we need to put the number of share first, then followed by the type of share capital. So this is 7% preference share. So 7% preference share means this share is receiving fixed dividend of 7%. So 4 million. second column. Then we total the net total, then we move on to the third column, 9 million.
Why 4 million?
Why 4 million? Okay, probably, yeah, the one share, the price is 2 ringgit. So 2 million times 2 ringgit, 4 million.
So on the left is not the
Yeah, because
price.
just now the note says nominal value is being abolished, so that's why it was not stated here.
So the left is just the number of the shares, not the price.
Yeah. Mm.
But we first would. So originally the ordinary share one ringgit per share, or will it be said? Will it be written in
So
the question?
with understanding, this one should be 2 ringgit lah.
Oh, it's okay.
Yeah.
Is it stated anywhere that the ordinary share is like cheap one is like 1 ringgit and then the preference share is 2 ringgit?
Last time, yes, but then now it's already been abolished, so they don't state the nominal value.
If there's a question, will they state it for us, or we have to figure out?
No, no, we have to figure it out lah. Like 5 million is 5 million, 1 ringgit. This one, okay, that is your understanding only. So like, if you have 2 million number of share, so you just divide value with the quantity, the number of share. So 4 million divided by 2 million is 2 ringgit each. Is that okay?
Or like I asked if we need to fill in and then but we don't know. We need to
Yeah.
fill in, but we didn't know about the share value.
Yeah, I mean, in total we know now, but per share, we don't know. Can you see me?
No, I just asked if the question.
No. Sorry. Can you see me on my camera?
No.
Is my camera on?
No.
Okay. What happened?
Oh, your camera not on.
Check this. Well, I think because of the line.
Maybe.
Okay. We continue. Now, after we have listed the share capital, then the next one will be reserve. So what is reserve? Reserve meaning these are the fund allocated by the company for a certain purpose. Like general is general purpose. Okay, like asset revaluation reserve. Okay, for asset revaluation, capital redemption meaning specific purposes to redeem any of the capital, right? So this reserve we put after the share capital. We list after the share capital. So we normally, the normal reserve that we would see in any company would be general reserve. Okay. So retained profit. Retained profit in sole proprietor or sole trader, we call this as profit, isn't it? But in company, we call it retained profit. Retain means the profit that is not being distributed as for dividend, not distributed to the reserve, to general reserve. Okay, so we call it retain, the profit that the company hold, okay, in for expansion purposes. Okay, retain profit. And then asset revaluation reserve. Okay, this reserve existed because of the asset of the company had been revalued or increase in value of the asset. Okay, this one normally will be done by professionals. Okay, and then that reserve will be recorded into debit the reserve, the asset, debit the asset because increase in value of asset, isn't it? Let's say the land, the value of the land normally appreciating, not depreciating, isn't it? So increase of land, I mean the value of the land, of course, is a debit item. So you do debit entry in the asset land, isn't it? So if there is a debit, there must be a credit. The credit will be in the reserve. So we call it as asset revaluation reserve. Now, capital redemption reserve, these are the reserve, okay, to be used to redeem the preference share, redeem the debentures. So we call it capital redemption reserve. Okay. So note, capital and reserve. So meaning we are referring capital plus reserve, which is 9 million plus this amount, 10,575,000. So this can be titled as equity also. So meaning this is the total, isn't it? So the particular here we can write down as shareholders equity. Yeah, shareholders equity. Okay, so can we have, just a 5 minutes break and then we continue with the rest of the theory? 5 minutes
Okay.
only.
Okay.
Okay. So still no electricity. Farah.
Yeah, sure.
Yeah.
Okay. So debenture. Debenture is a loan agreement which is typically unsecured obligation of the issuing company with claim on only general asset of the company. So meaning if this is an option for the company, let's say the company needs to increase the capital, that is loan capital, so they can opt for debentures. So this is unsecured obligation. Unsecured means the company, in order to get debentures, they don't have to, put an asset in case if they fail to pay the debentures, the debentures will take over the asset. No need. This is unsecured, meaning the company need not put the asset to get these debentures. Okay, they sell it to the public, so the public will buy the debentures and pay the money to the company. So that is considered as loan capital. Okay, debentures may be redeemable. Redeemable means repayable by the company at or by a specified date. Debentures may be convertible, so meaning we are talking about the possibility of the, whether the features, possible features, can be redeemable, can be convertible. If it's redeemable, so at a certain date, instead of redeemable, they convert it into share. Okay, the debentures are eligible to be converted into ordinary share or specified date. So the conversion rate specify when the debentures are issued. So may listed on the stock exchange, meaning the debenture can be bought and sold before its expiry date. So like same features like share capital. Therefore, the rights attached to the debenture are transferable. Okay, meaning at any time, if the debenture holder needs money, so they can sell off the debentures. So it is, you can get cash immediately if need arises. Okay, it should be noted that debenture holders are not members of the company in the same way as shareholders are. The debentures must not be confused with the share capital in the statement of financial position. So debenture should always be shown as non-current liability. So when you present in the statement of financial position, this is under non-current liability. So debenture holder is not members, not shareholders. Yeah, so they cannot vote unless they to be redeemed within 1 year from date of statement of financial position, in which case they are shown as current liability. So meaning every time debenture holder should be under non-current liabilities. But it can be under current liability if the repayment period is like less than 1 year. So secured creditor, just now is unsecured. Compared to debenture, secured creditor has claim on a particular asset of the company. Meaning, in order to get this loan, okay, the company need to put something, normally is an asset as a collateral, meaning gadai lah, gadai, pajak gadai. So they put the asset, so then the creditor, the secured creditor will give the money to the company. And then if the company not able to make payment, okay, after the expiry of the loan, So then this creditor will claim the asset, they sell off the asset, and then pay for the creditor. Okay, according to section 524, there are 3 options for secured director in the event of company bankruptcy. If the secured creditor is entitled to realize the charged property, they may do so and claim for any shortfall as an unsecured creditor. So meaning if they sell off the property can only, cost them 10,000, but the debt is 30,000. So the other 20,000, then they can claim as unsecured creditor. The secured creditor may value the charged property and claim for the balance as unsecured creditor. The secured creditor may surrender the charge of the to the liquidator for the general benefit of creditors and claim as unsecured creditor for the whole debts. So meaning this is an option given to secured creditor. Okay, the secured creditor may value the charged property. Okay, let's say the charged property is lesser than the amount they're giving loan to the business. So the balance, which is not secured, so they put as unsecured. Okay, and if the secured creditor, they are very generous, they surrender the property to the liquidator in times of liquidation, and the proceed, okay, will be divided among the other creditor as unsecured creditor for the whole debts. In other words, the secured creditor may either sell the property or give up the property for the good of all creditors. So they're given an option by this section 524. Now, when we okay, provide debenture interest, these are the double entry. So remember,
what kind of people can be secured debtors? Secured creditors, yeah.
What was the question?
Yeah, what kind of people can be a secured creditor?
Any individual, let's say individual, you have extra money, okay, they can provide loan to the company or even the bank, even the insurance company. They can give loan, but then the type of loan they want to give can be secured creditor or unsecured creditor. Secured creditor meaning for the individual giving loan to the business, okay, the condition is they will give the loan, but the company must put something as collateral, pajak gadai. That is secured creditor.
Oh, okay.
Unsecured means they give loan, no sharat. No, they don't. The company doesn't have to put any asset as collateral. Tidak ada pajak gadai. They can get the loan immediately.
Oh,
So
okay.
that is secure. Okay. Now the recording. So remember, debenture interest is fixed, just like preference share. Every year, regardless whether the business are profiting or not profiting, so the debenture interest still have to be paid. And remember, that is an expenses. So meaning expenses is a debit item. So when we record, of course, we debit the debenture interest. Now, if it's because it's obligation, so if it's paid immediately, then the double entry will be debit debenture interest, credit bank. Okay, why credit bank? Remember, bank is a debit item, so this transaction reduces the bank money. So credit lah. So if you understand, this is payment, credit bank, so the other entry should be debit. So why debenture interest is debit? Because debenture interest is an expenses. So a debit item, so increase of a debit item, you debit debenture interest. So that is the reasoning. Now, what about if it's not being paid? So we only do year-end adjustment. Year-end adjustment, that is, we need to provide, even though it's not paid, but it's already been incurred, isn't it? Debenture interest is due. So what we have to do, again, we have to debit debenture interest, and the corresponding entry should be credit. So where do you want to credit? So we call this as debenture interest payable. Okay. Hey, do you have class after this? You have
Hi, the
Tutorial.
tutorial.
Oh, tutorial, yeah. Okay. So we debit debenture interest, we credit debenture interest payable. So this is liability. Liability, because not being paid yet, but we already provide, we allocate. So this will be in the current liability. Okay. Winding up. Winding up meaning closing the company, because the company, most probably because of bankruptcy. So one of the ground for the company winding up is inability to pay the debts, meaning the company unable to pay the debts already. Currently, the amount set is 10,000. So they have the condition already. 10,000 if a company cannot pay, meaning they can be wind up, can be closed down. If the company can pay debts up to 10,000, 10,000 for company is too small, but then they still cannot pay. So meaning the company is in trouble already. So it is required to start winding up. So by Bursa Saham Kuala Lumpur or Suruhanjaya Syarikat Malaysia. Okay, 10,000 is prescribed by the Minister of Domestic Trade and Consumer Affairs as Suruhanjaya Syarikat Malaysia. So example here, a company has debt of 5,000 lower than the amount set by minister. So company is not required to wind up at this point. But then if it's 10,000 and above, okay, consider as if they cannot pay the 10,000 above, then meaning they need to wind up. Voluntary. So there are two winding up option, voluntary. Okay, this type of winding up commences when the members' resolution to voluntary wind up, members' resolution. Okay, 75%. Say that the company does not wind up, but goes for corporate restructuring instead. How does this work out? Okay, so you have a company have an option also. Let's say they cannot, the members make a resolution so to wind up, but then you are in position where you want to decide. So you have an option instead of closing the company, so you can do corporate restructuring. So corporate restructuring, meaning the management try to restructure the company. Okay, restructure the company by looking for a buyer, the share. So the buyer of the share in corporate world, they call it as white knight. White knight is to rescue the company, okay, by pumping in more capital or negotiating the loan with the bank, meaning you negotiate with the bank, okay, to extend your loan, okay, repayment loan, or stop the interest, and so meaning to buy time, to give you to survive from the
No problem.
economic
You finish
turmoil.
your lecture first.
Okay.
I'm actually marking your tutorial 8.
So the creditors may apply what is due to them as secured creditor. This could cause them to sell some of the company's asset while the company is trying to go for a turnaround. So what can the company do? The company can apply to the court for an order to restrain further proceeding against the company, except with the court's leave. Okay, court restraining order. So this is to stop legal proceeding against the company, to allow the company time to make new plan and look for friendly party to buy out the company. Okay, they need to get court restraining order first. The court can grant this order for not more than 3 months. Okay, so at that time, 3 months, then they have to look for white knight, okay, to save the company. All right. Okay, so I don't want to extend more. So do you have any question before we go?
No.
No
No.
question. Okay, so tomorrow, don't forget, 7:30, yeah?
Okay.
Okay, bye.
Okay, thanks.
Okay, sir.
And welcome.
Miss Farrer said he's no electricity.
Oh, yeah. Okay. No electricity. Can I use phone?